Two legendary market experts are stepping forward to warn we're in the earliest stages of what they call the Great Unraveling, a specific event starting to take root in America that's behind the recent crash in stocks and the record inflation you're seeing. But they worry it's about to get even worse. And many of the things you take for granted are due for a big disruption in the months ahead. Your Social Security benefits will likely be slashed. Your taxes are probably going way up. And many of your investments are likely to continue falling. Meanwhile, even if you think you've saved enough money to retire, you're probably going to need way more money than you thought. Your personal success all comes down to how well you understand what's heading your way. This is why I strongly encourage you to read about their warning today, totally free. It's all spelled out in a free report we've put together about the Great Unraveling. Get the facts yourself. Go to unravelingreport.com to get your free copy of this report. You can learn how to get their full playbook to prepare for what's coming. Again, that's unravelingreport.com for a free copy of this new report. Hi, I'm Daniela Cambone. Welcome back to the Daniela Cambone Show on the road here, home for the holidays in Montreal. And we are continuing with our Outlook coverage. And joining me today is a fellow Montrealer, Michael Gentile. He is the co-founder of Bastion Asset Management. Michael, welcome to our Outlook series, Power Shift 2023. How have you been?
Pretty good. Great to see you again, Danielle.
Yeah, nice to see you as well. And now we're catching up here before the Fed speaks. Now, we know the narrative, inflation cooling, CPI numbers coming in cooler than expected here. But should investors be breathing a sigh of relief yet? What will be the Fed's next moves, Michael? How do you see it?
Yeah, I think the celebrations are a bit premature, Daniela. If you look historically, I think the Fed is close to the end of the hiking cycle. They've started to telegraph that. I think today they're still going to hike 50 basis points, if anything, just to give themselves some more room in the future to cut rates when things get worse. But if you look at historically, when the Fed stops a Fed hiking cycle and starts to pivot to cutting rates, the market actually performs very poorly. So I think the market is celebrating prematurely, is celebrating potentially the wrong thing, because what investors have to ask themselves is, why is the Fed pausing? And why is the Fed eventually going to be cutting rates as the market is predicting on the Fed futures curves? Is likely because the recession will be deeper and harder than people think. So typically stocks have a hard time at the pause point or at the beginning of a rate cut cycle, because the economy is decelerating and getting worse in real time. So the celebrations may be shorter lived than we hope here, with the market celebrating a pause, because what comes next will probably be an economic recession and lowering earnings estimates and potentially a choppy market again in 2023.
The last time you were on, Michael, you were saying that the market had up until that point been very complacent and basically listening to the Fed's every word. So are you saying a rebellion could happen now, where the market's going to be like, enough?
I think this time last year, I think we spoke almost exact same time last year, Daniela. The market was extremely expensive. The market was very complacent about the Fed actually getting aggressive about hiking interest rates and fighting inflation. I recall telling you, if the Fed ever did get serious about hiking rates, that the market would have a really difficult time, and that's exactly what happened last year. I think right now the market's less complacent. Exactly. The market's got beat up pretty badly. There's a lot more value that I see in the market. Small cap stocks, certain parts of the market have really got crushed, versus last year, everything was pretty much uniformly expensive. I remember telling your viewers, just hold cash, gold, and silver and wait for a better day. I'm not saying that better day is here today, because now we're facing a slowing economy, which typically is hard for stocks to work into, but there is more value in single stock names. And if you're a good stock picker, you can find names that are down 70, 80, 90% off the highs, where last year that was not the case. So I think it's going to be a choppy market where, you're not going to have the tailwind of 20% a year returns for 10 years like we had the last decade of the market, but really you have to earn your mettle picking stocks, taking profits, being more tactical and more flexible in your investment approach than versus the typical buy and hold approach that we had for the last 10, 12 years that worked very well until it didn't.
And I just want to say, we'll get back to sectors you're liking in a bit, but you were right on the money last year when we spoke. At this time, you had forecasted that it wouldn't be a good year for equity. So now you're saying choppiness for 2023.
Correct. And what's going to determine whether it's choppy or significant pain for investors in 2023 will be the extent of the economic downturn And that's going to be dictated a lot by the Fed in terms of how long they keep rates higher. They're talking about keeping rates higher for an elevated period of time. The Fed fund futures are showing rates coming down rapidly in 2023 and 2024 once they're done hiking rates. If the Fed chooses to keep rates at that 4.5–5% level for an elevated period, I think the economy is going to be in a difficult position and stocks will have a hard time working. If the Fed does truly pivot and starts cutting rates aggressively, I think it'll be more of a choppy market where the market will cheer the rate cuts but be worried about what the economy is actually doing behind the scenes, and it'll be a bit of an up and down, battle over 2023. So a lot of it's going to depend on how aggressive the Fed is and what the implications are for the economy of their posture.
Michael, I know you like studying history and often look to history to figure out where we're going next. And just getting back to the inflation narrative, if we compare it to the 1970s, we know that it didn't just come in one wave; it was 3 waves. So would you not agree this is just the end of wave 1?
Yeah, very likely. One thing I've been saying a lot, Daniela, is we're going to have to choose as a society, as governments, as the central banks, between higher inflation or lower economic growth. We're going to be entering a period where, typically if you had 2% inflation and 3 or 4% GDP growth, I think that paradigm is going to shift going forward to 4% inflation with 2% GDP growth. And what that really means is negative real growth. Or slower, subpar economic growth. Your point on the inflation is a very good one, Daniela. If you look at the cause of inflation, the most of it is supply driven. We have a lack of commodities, underinvestment in commodities across all sectors, which are pushing up commodity prices. We have lack of labor. We have lack of productivity. We have lack of hard work. We have a lot of red tape and bureaucracy in our countries, Canada and the US, which affects productivity. That is much harder to fix. You cannot fix productivity and supply shortages with a blunt hammer of interest rate increases. That'll kill your demand, but it won't solve your supply problem. So as soon as the demand starts to pick up again, if your supply is still constrained, you're going to have inflation running hotter than it has for years, I think, for a long period of time. So if 2% was the old paradigm, I think 3 to 4% might be the new paradigm or higher, depending on what the Fed wants to tolerate. But the fact is we're going to have higher structural inflation for longer. Not the 15–20% numbers we were seeing in the trenches last year, but it's going to be structurally higher for longer is my view.
Risk of recession is very real for you next year?
If you look at the inversion of the yield curve, Daniela, we've rarely seen this type of extreme inversion in the yield curve. And the bond market's typically a more savvy predictor of economic future than the equity markets are. So yes, I think we're going to have a recession next year. The real question for investors is how deep a recession, how severe a recession are we going to have? And again, like I said, that'll depend a lot on if the Fed actually sticks to the rhetoric and keeps rates higher at 5% for 2 years. I think we'll have a very deep recession. If the Fed pivots, which they likely will do, I think you might have a more moderate recession. But that's why I'm still forecasting a choppy, difficult year for investors in 2023.
Let me ask you this. As we inch closer to a presidential election in the U.S., you don't win an election in a recession or with a very poor stock market. Now we know that the Fed operates independently, but would you not think the Fed would want to see a better market here?
I think Joe Biden and the Democrats would like to see a better market for sure and see better job growth and not see that nasty recession scenario that we potentially have one of our outlooks for next year. So yes, I think the nature of governments are that when they're faced with a tough decision, they'll kick the can down the road. So rather than stomaching a very difficult recession, you'll probably see rates being cut. You'll probably see the government trying to step in yet again and throw more money into the economy through government spending programs, which are typically highly inefficient and very inflationary. So my view is, yes, we're going to see more government intervention, whether it be through Federal Reserve rate cuts or government programs, stimulus checks, whatever you want to call them, going forward, which is again inflationary. And it goes back to that narrative of we'll have GDP growth, but inflation will typically be running hotter than GDP. So it'll be an illusory growth. People will be getting poorer. Their paychecks will not be going as far. We'll have positive nominal GDP, but at the end of the day, it's not going to be the kind of GDP growth that creates real wealth and helps people lift themselves out of economic situations.
People will be getting poorer. Michael, what's the story for the U.S. dollar? Where do you see it headed?
I think the U.S. dollar likely has peaked. Again, given that the damage is being done to the euro. You see what happened this year. One of the big stories for this year for me was the euro and the yen and the devastation you saw in those two currencies. And really what those countries, they're the canary in the coal mine, right? The European Union and the Japanese economy can tolerate lower rates than the U.S. can. So as the Bank of England saw 5% rates, they panicked and had to intervene in their bond market and demolish their currency in the process. The Japanese have been doing yield curve control for years. You see what that's happening to their currency now. But I don't think the U.S. is any better. I think the U.S. is just a better house on a bad block, and they're facing the same issues. As interest rates go to 5%, $32 trillion of debt, Daniela, is $1.6 billion a year of interest expense at a 5% interest rate. The interest rate 2 years ago was $300 billion. That's a 5 to 6 times increase on your interest expense on the federal debt. I mean, that's just at 5%. That's why I believe the Fed, no matter what happens, they're going to have to slow down the rate hike cycle regardless of where inflation is, because all these global governments cannot afford the interest on their debt. And so they're going to have to choose higher inflation for longer to monetize their debt and float their economies. And that once the market realizes that the U.S. is in the same boat as those other countries, the U.S. dollar should weaken on a relative basis because all these countries are facing the same structural issue. Too much debt, not enough productivity, not enough money to pay off their interest.
I mean, the numbers, as you know, are just mind-boggling. So let's talk about who wins, who loses, given the scenario you've painted. Last time you were on, you obviously like gold, you like the junior miner sector, you like silver. How does gold fare? First of all, how would you assess how gold performed in 2022? We know we're down around 2% year to date. What's your assessment of it, and where does it go in 2023?
Look, gold, I've been saying for years, is a safe haven, and I think it did a phenomenal job in 2022 proving itself. It outperformed bonds, stocks. It pretty much outperformed everything except oil, which is driven by a global war, which is obviously an unpredictable event in the future. So gold and silver did their job in 22 on a remarkable basis, preserving the wealth of investors. And I think you're starting to see late this year the emerging signs of fund flow starting to return to the sector. You're starting to see some of the large cap names start to work. You're starting to see silver outperform gold, which we have not seen, Daniela, for several years. When silver leaves, that typically means some of the speculative money is coming back to the sector. So I think you're going to setting yourself up for a nice year in 2023. The sector remains dramatically underowned. Very few people, institutional investors, still own gold or allocate to gold. And when you're looking for a choppy market, recessionary risks in 2023, not a lot of direction for the market, when gold starts to outperform, that'll attract more fund flows because it'll be the one sector that likely be working into the new year. And that a very small amount of money can move the sector very quickly, Danielle. As you know, it's a very small market cap sector. So as money starts to flow into the sector, the moves in the stock prices can be quite dramatic. So I remain quite constructive on precious metals.
You said it. The mining sector was especially the junior sector, just destroyed this year. So could be a good buying opportunity here, Michael. Some names you're liking.
I'll stay away from single names. Just in my new co-founding of Bastion Asset Management, Danielle, I'm not really able to talk about single name stocks publicly. The mandate we have from our compliance team. But I would say in general, the small cap explorers and the developers are trading at extremely low valuation. I'm talking about that kind of $500 million to $200 million, $50 million to $200 million market cap company. They're trading at record low valuations. The large cap producers are generating record free cash flow. Their stock prices are starting to work really well. I expect a big M&A cycle in the next 2 years in the sector, and these names are trading at rock bottom values with also the increasing gold and silver price. They can see multiple expansion as well as M&A activity, which should light a fire under the sector. So those smaller names that have been left for dead should do quite well in 2023.
How important is it then to have cash on hand? How much cash in one's portfolio to be ready to go in here?
Yeah, like I said, I think being tactically flexible, having cash, being able to deploy as the volatility continues in 2023 and those single stock opportunities that you see will be key. Obviously, we've seen what's happened in the crypto space. Being on margin or levered up into volatile markets is a recipe for disaster. So I think having the flexibility to be cash, not overinvested, not over-levered, not on margin, will give you the flexibility to do well in 2023 if you take advantage of the opportunities and not be afraid to step in when stocks are getting pummeled. If you have a quality name that you believe in.
Last point, you just mentioned it, crypto. Let's talk to crypto carnage. What are your thoughts on Bitcoin specifically, Michael?
Yeah, look, I'm not going to say I'm an expert behind the technology behind Bitcoin, but what I saw last year when we spoke this time last year, Daniela, was just a massive speculative bubble. The type of behavior when you have Tom Brady, Super Bowl ads, Lindsay Lohan, and everybody pitching the same thing. Retail participation, the kind of behavior that was around the whole cryptocurrency sector was very typical of a top of a bubble. Now, like you saw in the 1990s in the dot-com boom, the internet was a very big thing for the world and it was a very valuable technology, but 99% of those dot-com companies end up going bankrupt during the crash in 2001, 2002. I think the same thing is happening in the crypto space right now. It's a cleansing. It's very painful for those investors that are invested in Bitcoin, but it's a healthy process where the 99% of the fraudulent or the less real cryptocurrencies and coins are going to get washed out and go to zero. And there'll be a few winners that'll emerge on the other side that will likely become investable names in the future. This is a healthy process on the other side of a bubble, but we're not done yet. There's still quite a few of these coins that I think are, to me, are worthless. They have no value, that are still have 10, 20, 50, $100 billion market caps. That has to get completely washed out before the sector can really start to work structurally long term.
But Bitcoin sticks around.
Bitcoin likely should stick around. And I'm not here to say, like when it was at 45, 50,000, I thought it had very vulnerable. Down here, 16, 17,000. I'm less negative than I was on Bitcoin before. That being said, you've seen it run on the Binance exchange overnight last night. There still could be more pain. I don't know if Bitcoin's bottom is going to be 5,000, 10,000, or it's here. But what I'm saying is this process of cleansing is very, very healthy. If you're not on margin and you can have staying power, you should be able to see through to the other side. But be aware this cleansing will take several more months, if not years, to completely wash out the sector.
Would you be a buyer here of Bitcoin?
No, because I still think it's highly speculative. I think gold and silver have proven yet again that they're the real stores of value. They're the real alternative money when things get difficult. I think Bitcoin the technology behind Bitcoin or crypto will end up having value. Who the winners are, which are the final champions of this sector over time. That's the hard part about tech. It's really hard to pick winners in tech. The cycles are short. The technology is unpredictable. Innovation is always there. So there will be winners. There likely is a space for cryptocurrencies in the future, but we're still in the washout phase, and it's hard to know which ones will come out the other side. That's why I prefer to put my money in gold and silver, which have been money for thousands of years and will be held in the future for thousands of years as well.
Michael Gentile, I appreciate your time today. Thank you for catching up with me ahead of the Fed. And if I don't speak to you again, Merry Christmas. All the best.
Same to you, Daniela. Good to see you.
And thank you all for watching. Our Outlook Series Power Shift 2023 continues. We hope you're enjoying it thus far. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.